Maya, thank you very much for that introduction. It's a great pleasure to be here today, and particularly to be amongst this group, because I know in this group, although I don't know everyone, I do recognize a lot of familiar faces and are very well aware of how this group is very committed to playing a key role in addressing this huge challenge that society faces, and playing a huge role in delivering the solutions. What I was going to do just in the next 5 minutes is talk to some really specific data points around finance under 3 headings. Green bonds have been mentioned, so I'll talk a little bit about what's happening in the green bond space. I'll talk a little bit by reference to some survey work that we've done at HSBC around investor sentiment towards ESG investing and bringing capital to finance the new asset creation that's required to address this challenge. And then in the sort of the third point, I'll talk to a little bit to what commercial banks are doing, and particularly in the area of disclosure, which commercial banks now need to address. So the first point on the green bond market, these pies here show how the market has grown, but before looking at the numbers, perhaps a key observation is that 2017 has really seen the emergence of social bonds as a product which has emerged now to sort of sit alongside green bonds. So we have green bond principles established under ICMA, we have social bond principles, and we also have something called a sustainability bond, which very simply is a bond where the use of proceeds can be applied to both green and social uses under the same bond framework. So this segment now, we refer to it as the GSS segment. So the numbers I'll talk to will be in relation to the GSS segment. Volumes this year have reached about 140 billion US dollars. That's about a 40% increase over volumes in 2016. But it is important to note as well that it's still a relatively small component of the overall capital markets, representing just a little bit less than 2% of total fixed income issuance. So fast growing, but growing from a small base. You can see Asia continues to play a significant role in this segment. Asian issuance this year is about 30% of total global issuance. It's slightly down. Asia's percentage is slightly down this year because China's issuance has dropped slightly, as China has actually issued less into the international capital markets this year than it did in 2016. But I think the sentiment towards green still remains very strong. In Asia, we've seen important transactions this year coming out of a variety of markets, from Australia, including where we've seen a number of these social bonds. Gender equality bonds have been quite a theme from Australia. We've seen transactions out of Korea and the financial institutions sector. We've seen banks in Singapore. We've seen Hong Kong entities. We'll include the CLP bond as a green bond for the purposes of this discussion. And we've also seen a lot of activity, continued activity, particularly out of India, where particularly the renewable energy sector has used green bonds to tap into, raise capital via from the high yield markets. And when we look at our pipeline and when we think what we might see in 2018, we're going to see, I think, a whole new set of markets that we will see in 2018, including, I think it's now very high probability, we will see the first Asian sovereign green in 2018, and you can place your bets as to which country that might come from. So that's the green bond market. An important, I think, key takeaway there is the growth and emergence of social bonds. We, HSBC, just 2 weeks ago, we launched the first Sustainable Development Goal bond, where we tried to link the proceeds of a $1 billion issuance to delivering or supporting entities who are clearly delivering against 7 of the 17 UN SDGs. So again, just an example of how social bonds and the social application is closely linked to the green application, as previous speakers have talked to. The other interesting thing we've seen this year in green bonds is, for the first time, we now have our fixed income analysts suggesting that green bonds are trading in the secondary markets, some green bonds, at higher prices than non-green bonds. Now, to anyone in the world of finance, that's quite important. That's a saying to investors, buy green paper and you can expect a slightly better return, potentially. It's not a huge number of issuances yet, but it's a material number of issuances. It's mostly from developed market issuers. We haven't yet seen that from emerging market issuers, but it's a very important. This is the first year we have seen this. We're not the only house whose research people have identified this, but it does suggest we might just be at a tipping point. That huge volume of investor interest that wants to chase green paper, it's now starting to influence pricing in secondary markets. And of course, if you're an issuer who has a green bond out there and it's trading tight in secondary, that's creating a clear and improved benchmark for when you come to do your next primary issuance. So a lot of encouragement now to issuers to get out there, set up their frameworks, get ready to tap into this very competitive cost of capital. We haven't seen it in primary yet. We have to be straightforward about that. We can't tell our issuing clients you'll get your money cheaper on day one if you issue today. But I think what we can say is that the outlook is that you certainly don't pay more. So when you issue in green format, we haven't seen a single case where you end up paying more than we believe the issuer would have paid if they'd gone in non-green format. So there's no downside risk, I think, is the key message here. Some of the surveys that we've done, and this is sort of turning to what investors are saying, the key message now, I think, is that a substantial majority of financial investors are increasingly putting ESG criteria into their investment decision-making processes. So the numbers at the top talk to how familiar are you with green bonds and are you buying them, for example, as one measure. The different rounds here are, this survey was done, I think, over 2 years, so they're sort of 6 monthly rounds, and you can see the percentage of interest and appetite increasing. In terms of the number of investors who are already factoring ESG into their decision-making process, that's very clearly increasing. The box on the bottom left, up to 35% now, already factoring ESG clearly into their investment decision-making. Unfortunately, on the bottom right, you can see Asia continues to lag slightly behind. Asian investors not so focused on ESG as investors in the rest of the world, and particularly in Europe. Another survey we did here, which talks to, again, how engaged are investors. Highly engaged in Europe, not so engaged in Europe. Familiar themes there. In terms of investors' statements about what they're going to do next year, 97% of investors in Europe saying they're going to buy more green next year than they bought this year. Still a high number, but a lower number in Asia at 68%. All of these numbers are available on our website. So if you're scrambling to take the notes, you don't need to worry. This part of the survey talked about corporate issuers. What are corporate issuers doing? Yes, they're all saying I'm going to make more investments to decarbonize my business, make my operations more efficient, and they're clearly financial drivers to that. When you look on the right-hand side, this does talk to what's causing that. There is an expectation that those investments will yield strong financial returns, but there's also an acknowledgement from corporates that actually they are also under a certain amount of investor pressure to act responsibly. They would like to see tax breaks, but obviously in many cases they're not receiving tax breaks currently. So that's the corporate view. One of the key impediments to increasing these flows is the area around disclosure. On the previous slide, you could see investors saying one of the big concerns, they weren't getting enough disclosure from issuers. And we're now seeing, I think, a recognition from issuers that they need to address and improve disclosure. And we'll come on to that later in a moment. What are banks doing? Maya asked me to talk about this. This was a statement made by HSBC just prior to Bonn. We made 5 commitments at that point in time. Number one, was to provide $100 billion US of financing to develop green low carbon projects. Number 2 was to procure by 2030 100% of our power that we use in our offices in a zero carbon format by 2030. Is a slightly unusual step in this process, so we're targeting 90% by 2025. The reason for that, in part, is Hong Kong. We have to work with Genie and the other power companies here to work out just how we're going to do that in Hong Kong, and obviously as a chunk of our energy that we do buy here in Hong Kong. Number 3, we've further tightened and are continuing to tighten our lending policies into high carbon sectors, particularly thermal coal mines, which we're now not financing, and we're highly selective around coal-fired power plants, so we'll really only do it in low-income countries using state-of-the-art supercritical or ultra-supercritical technology, and in markets as well where we perceive there's a limited renewable alternative, so we're being increasingly selective on that business. Number 4, adopt the recommendations of the Task Force on Climate-Related Financial Disclosures. I expect many people in this room know what that is. Many of the people I talk to in the bank have got no idea what that is and what we need to do, but this is very important. Number 5 is to continue to try and lead the debate on thought leadership around sustainability issues, and including amongst that standards and metrics, and providing the support and input to what we believe is very important, for example, to see a more general adoption of carbon pricing in global markets. Just final comments on TCFD, because this is affecting the banks very significantly. The FSB, which most of you, or some of you may know, really was formed, the Financial Stability Board, formed by the G20 as a consequence of the global financial crisis about a decade ago, to look at financial stability of the financial markets, identifying people like banks like HSBC, globally systemically important banks. One of the work groups of FSB is around climate-related disclosures. So the TCFD produced its report and recommendations in the middle of 2017. This report sets out a couple of key areas, the identification and categorization of risks, particularly into the area of transition risks and physical risks that are faced by financial institutions. So we look there at all the financial institutions would then be required to disclose their exposure to those risks and how they're managing those risks. Important to note here as well that the scope of TCFD is not just commercial banks. It goes to money managers, asset owners, it goes to the insurance industry, and in fact it goes as far as all users of public capital markets. The challenge with the TCFD, of course, is that it's quite high level. The report is issued, it sets out a lot of concepts and principles, but obviously the detail of implementation of those is really being left to market participants and specific individual market regulators as this moves forward. One of the key areas, of course, under this whole assessment of sustainability risk, transition risk, however you choose to describe it, the risks that financial institutions are facing, of course, involves a completely new approach to risk analysis, because much of the way financial institutions have assessed risk has been a sort of a backward-looking empirical type of analysis. Clearly, with sustainability risk, most of these risks will only manifest themselves in the future and going forward, and the rear view mirror, in a sense, isn't very much use in assessing these risks. So a key tool that's been set out by TCFD is this concept of scenario analysis. So looking forward as to sort of what happens if society decides it's no longer acceptable for transportation companies to carry hydrocarbons, for example. What would be the impact of that on our clients? What, for example, would be the impact if there was a carbon tax imposed at $50 per ton or $100 per ton? How many, what would be how many of our clients would go out of business? What sort of losses would we face? How would asset values change? So this concept of scenario analysis being absolutely key, this sort of look forward analysis to what might happen under different scenarios in terms of tightening regulations, restriction on businesses, and so forth. So I'm going to stop there, not least because time is up, but also keen to leave time for the Q&A at the end. Key messages, though, there's a lot of capital out there. Capital is highly incentivized and highly interested in supporting and financing the process of this massive need for creating low-carbon, non-polluting assets. Financial institutions have a huge role to play in that. As intermediaries, if we get it wrong, that's the risk part of this. We're going to be in trouble. If we get it right, and this is my story to my senior management, we can make an awful lot of money out of this and then grow our market share. But as an institution, obviously we're very committed to playing our role as an intermediary and bringing those large quantums of capital to investments that are financially viable. And that's our commitment to the market and to society. Thank you.